Hello, everybody. This is Bennett Tchaikovsky, and welcome. We're going to be redoing a video today because I made a mistake, and I want to thank my intermediate accounting students this summer for correcting me and righting my wrongs. So today we're going to be dealing with non-current liabilities and when a bond is issued in between interest rates, and then if some of those bonds are redeemed. So let's go right to, by the way, just really quickly. My disclaimer and copyright notice is that the informations and opinions in this presentation are those of myself and not my employers or affiliated organizations, including but not limited to Irvine Valley College and the South Orange County Community College District. The presentation is for educational purposes only and does not constitute any legal or accounting advice whatsoever. This presentation is copyright 2008 to 2026 by Bennett Tchaikovsky. All rights are reserved. Any distribution is strictly prohibited. Throughout the presentation, I will make references to publicly available information. That is the copyright of other parties. I do not claim any right to the copyright in those third parties. So let's go ahead and take a look at our sample question, right? So we've got over here on March 1st, 2020, Spectre issued bonds with a face value. Oh, well, dad joke play on words here. That's a lot of fun. Okay, let's go ahead and take a look at our question. And what I will go through and do is I'm going to basically duplicate this and just give me one moment. Okay, so let's go ahead and take a look at this. So we've got this. On March 1st, 2020, Spectre issued bonds with a face value of $15 million at 98 plus accrued interest. The bonds were dated January 1st, 2020. The stated interest rate on the bonds is 6%, and the bonds pay interest semi-annually on June 30th and December 31st. Any premium or discount is amortized straight line. The term on the bonds is 10 years. So what we want to do here is we want to prepare the journal entry to record the bond issuance on March 1st, prepare the journal entry to record interest expense, prepare the journal entry to record interest expense for the 6 months 12/31. Then we're going to have a bond redemption on July 1st, and then we're going to go ahead and then do prepare the journal entry to record the bond retirement, and then the subsequent entry for interest expense. So this sounds like a lot, but let's go ahead and break this down. So the first thing is over here on 3/1/20, we're issuing bonds at 98. Okay, and what this really refers to is that it's basically at not the full face value. Remember, when we go through and record bonds payable, we always have to record them at the full face amount, or 15, in this case here, it's going to be $15 million. Now, when it comes to the normal entry we would be making is we would be basically be debiting cash. And because the amount of cash we're going to be receiving right at the bond payable here is at 15 million, and we're only getting 98% of those proceeds, the amount of cash I'm receiving is 14.7 million. So the difference between these two is going to be my discount on bonds payable. And this is going to be to record bond issuance. Now, because this is a little bit like funky, on 1/1/20, the bonds are dated, right? So the bonds payable are basically dated January 1st. What does that mean? Well, from January 1st through June 30th, these bonds will basically be paying interest, right? So right over here, the bonds are going to pay interest of how much? Well, but you see basically the bond payable, the stated interest rate is over here at 6%. Whenever you see an interest rate, though, it is always going to be an annual rate. So the annual interest is going to be 15 million times 6% or 900,000. However, that is not, that's an annual amount. My bonds are paying interest every 6 months. So I need to multiply this value here by 6/12, or this will give me 450,000. Now, so this is going to be the semi-annual interest. So on June 30th, right, what's going to happen here is that this bond is basically going to pay out 450 grand. Now, if I'm the company and the bond is I'm contractually obligated to pay the full 6 months of interest on June 30th. But what's going to happen is like, wait a second, Mr. Investor, you weren't around for these for January or February. So therefore, what we're going to ask you to do is you're going to pay us that interest. So how does that work? Well, if 450,000 is the amount of the semi-annual interest, and that represents 6 months, then what I'm going to go ahead and do is multiply this amount by 2/6, or February or January plus February. This is really being divided by 6 months. So the investor is going to go through and they're going to basically prepay this by roughly 1/3 or 150,000. So in addition to receiving 14.7 million, I'm also going to be receiving cash of 150,000. Now, what I also want to go through and do though, when I pay this cash out on June 30th, right, they're just kind of advancing me the money. So I'm going to record this as interest payable. Now, at the same time, you will see things in the textbook. You could also use interest expense. That's fine. I would accept either answer. But over here to record interest advanced by investor. Now, is this the only way I can go through and record this transaction? The answer is no. There's also another way we could go through and do this. And that would be by going through and combining these journal entries. I'm just going to push this over here to the side a bit. Okay. So if I were to combine these journal entries on 3/1/20, right, I would be debiting cash for 14.7 plus 150,000 or 14,850,000. I would also be debiting the discount on bonds payable for 300,000. I would also be crediting bonds payable, always going to be at the face value. And then I would also be crediting interest payable for 150,000. Same result to record bond issuance, right? So same thing. If you're in my class, I would accept either method. Okay. Now we get to June 30th. Remember, when we have a bond, right, and this is say 3/1/20, and I have over here bond under my non-current liabilities, I'm going to have bond payable less discount is going to give me bond payable net. Okay, so my bond payable here is at 15 million. My discount on bonds payable is going to be negative 300,000. Why is that? It is a contra liability account. So my bond payable net is going to be at 14.7 million. Now, what happens with this discount on bond payable? Well, the discount on bond payable right over here. So this is going to be my discount on British Petroleum or bond payable. It's going to have a debit balance. Ultimately, it's a 10-year bond. So by 12/31/29, I'm going to want this. And by the way, one of my students corrected me. This would basically be a current liability as of 12/31/28. But I want my discount to go down to 0. So what I'm going to need to go through and do is, as I'm recording interest expense, I'm going to amortize this discount on bonds payable. Now you see me go through and do different items over here when we are going through and using the effective interest rate. The discount amortization or the discount, that's going to be a function of basically of interest expense. Here in this example, interest expense is going to be really a function of the discount because we're amortizing the discount straight line. So let's go ahead and take a look at this over here. So when I'm going through and I am basically I'm going through over here. So here I've got cash going out. I'm going to be debiting interest expense. Remember, when I'm going through, and the reason why I use T accounts, right? Assets equals liabilities plus owner's equity, expenses, revenues, debits, and credits. What I will try to remind myself to do is that I do have a lot of bond videos that are much more simplistic than what I'm going over with you here today. I will leave links for those. So if you want to go back and review, more than happy to go through and to do that. So I'm going to basically be debiting interest expense, and I'm going to credit my discount on bonds payable. But at the same time over here too, is that when I'm paying out this cash, I'm going to be simultaneously be getting rid of this interest payable, at least on this first journal entry over here, right? Because when when the interest is paid, the investor advances to us here, and I'm now going to basically pay him off. Okay, but when it comes to this discount, if I'm amortizing it straight line, okay, this is a 10-year bond. It's basically paying interest semi-annually or 2 times per year. So I'm going to have a total of 20 interest payments. Normally, if the bond was not being issued in between interest dates, I would just take this 30,000 divided by 20 and I would be done. But we've got a problem, right? The bond is starting up on 3/1/20. It's going to be ending on 12/31/29 or basically at the end of that 10-year term. Because remember, the bond was dated 1/1/20. So if the bond is a 10-year bond, right? And if I basically say, well, how many months are in this 10-year bond? Well, basically 12 months per year. This is going to be 120 months. So this would be for the full term of the bond, but my bond is not outstanding for those 120 months. Why is it not outstanding for those 120 months? Because the bond was not issued from January through the end of February. So what I need to do is I need to come over here and say, well, it's not 120 months. I need to subtract 2 months for January of 20 plus February of 20. So I'm going to get a total of 118 months. Okay. So now my monthly amortization is going to be on the discount on bonds payable is going to be the amount of the discount divided by the number of months. So my monthly amortization on this discount on bonds payable is going to be basically 25, 42, 37. I'll just call it 25, 42. I'm just going to round it. So when I come over here to amortize my discount, well, during the 6 months ended June 30th, it was only outstanding for 4 months. So I'm going to take the monthly amortization, or the 2542 times 4 months, or March 1st through June 30th. Okay, so right over here, 2542 times 4. Okay, I'm going to get 10,168. Now, the difference here, right, whatever I need to do to balance is going to be my amount to interest expense, which should be 310,168. And that looks correct. So again, when we are going through and we are amortizing the bond, the discount or premium straight line, we figured out this number first, and then we're going to back into the interest expense. Remember, if I am making an interest payment in between dates, I need to exclude those because the bond is not really outstanding for 10 years. It's really outstanding for 9 years and 10 months or 118 months. So this is going to be to record interest expense. Now remember, I'm also too, when we think about this interest expense, right, when I get over here to 1230, right, 1230.20, I'm going to be paying out cash of the same amount of 450,000. But my interest expense is going to be much higher. Why is it going to be much higher? Because, well, when I have my discount on bonds payable, I'm going to be amortizing this by 2542 times 6 months, or July 1st through December 31st. So my interest expense is now going to be 465,252. And you might be saying, well, wait a second, why is that bigger than this amount? Well, here, my bond was really truly only outstanding for 4 months. So the interest expense should be going through and reflecting that. So let's go ahead and take a look at what we've done so far. So we've prepared the journal entry to record the bond issuance. Like, remember, there's two different ways you can do it. You can either show it as, use a different highlight. Let's go ahead and use this one. I can either split it up or I can combine it. Either way is good. Next one over here is prepare the journal entry to record interest expense for the 6 months ended 6/30. Over here, I had to get rid of that interest payable. I basically have my discount. Remember, that's only going to be used for 4 months. And then my balance, I'm always going to be balancing with my interest expense. Okay, so then over here, and then lastly, I also did the journal entry to record this for basically for this part over here. Now, if I were to go through and like just say over here that my discount on bonds payable was 300,000. And again, what is my goal with the discount on bonds payable? When the bond matures, I want it to go down to 0. So if I looked at this here and I said, well, on for 6/30/20, I went over here and did it for 10,168. And then over here from basically for the other 19 interest payments. Remember, there's a total of 20 interest payments, 10-year bond times 2 per year, 19 interest payments times 15,252. This is going to get me pretty close to that 300,000. Remember, I rounded down. That's why it's a little bit different. But ultimately, remember, with my discount on bonds payable, I ultimately wanted this to go down to 0. Okay, so now for the fun part. Assume that $4 million of the bonds were retired on 7/1/22 for $3.9 million. And this is why I'm redoing this video. Prepare the journal entry to record the bond retirement. And then it's asking me to go through and to record the interest expense for the 6 months ended December 31st, 2022. Let's go through and take a look at this. When I'm dealing with a bond retirement, right? So there's a couple different ways I can do this, but I'm going to show you the way that I kind of prefer. And again, this is my own personal preference. You can have different ways of doing it. So pre-retirement, my bond payable was initially issued over here on 3/1/20 for $15 million. Okay. Okay. Now, at the same time, I had a discount on bonds payable at the same date over here for 300,000. But what kind of has been happening with the discount? Well, up until the date we're going through and retiring these bonds, how much amortization has there been on the discount? Well, if I take 6/30/20, 12/31/20, 6/30/21, 12/31/21, and then 6/30/22. And why am I choosing these dates? Because basically the bond is being retired on July 1st, 2022. So here, right, on the very first time I amortized the bond, it was at 10,168. Subsequently, I was going through and doing this at 15,252 throughout. So prior to the bonds being retired, right, the basically here, my discount on bonds payable is going to have an ending debit balance, right? Subtract the smaller from the larger side, leave the remainder on the larger side of 228,824. So this is what this looks like for the full $15 million of the bonds. Now, what the question tells me though, is that right over here is assume that I am going through and I'm basically retiring 4 million of this 15 million. And I think one of my former students, her name was Ingrid Felikowski. Ingrid, well, just called you out. It's okay. She basically, I think, came up with the method of like, hey, Tchaikovsky, why don't you basically split it up? Keep them separated. Okay, so right over here, what we're going to go ahead and do is we're going to basically say that with bonds payable, or basically we'll call this bonds payable, keep the amount of the bonds payable if I'm retiring 4 million of the 15 million, this is going to be 11 million. Okay, so my bonds payable that I'm keeping is going to be here at 11 million, right? And then I'm also going to have my discount on bonds payable that I'm keeping. Now, how do I figure out the amount that I want to go through and record this? Well, what I'm going to go ahead and do is I'm going to take 11 million. I'm going to divide that by 15 million. And this is going to basically give me about 73%. So what I'm going to go ahead and do to make my life a little bit easier is I'm going to basically say, okay, I'm going to assign 73% to what I'm keeping for the discount. And then the difference here, or 27%, which I'm basically selling, is going to equal to 100%. So what I'm going to do for this discount is I'm going to take 228, 824, and multiply it by 73%. And now for the bonds that I'm actually going through and retiring, this is going to be 4 million. And this is going to be 228, 824 times 27%, or 61,782. I want to make sure that this equals the total balance. Okay. So now when I go to retire the bonds, how is this going to work? Okay, now on 7/1/22, okay, what's happening to my bonds payable when I retire them? Well, this is going to need to go to zero. So I'm going to go ahead and debit bonds payable for $4 million because I'm retiring them. Okay, so right over here, I'm debiting bonds payable for 4 million. And this bonds payable now is going to have a zero balance. Okay. I have to do the same thing with my discount on bonds payable. I need this to also go to zero. So I'm going to go ahead and do here is I'm going to credit the discount on bonds payable for 61,782. Okay. Now, how much cash am I actually going through and paying to retire these bonds? Well, right over here, I'm going to basically be paying 3.9 million. So to retire them, I have to spend 3.9 million. And now we're going to learn where I messed up, which was I think I was recording a loss instead of a gain. And let me just kind of talk to you a little bit about this. When I need a credit to balance the account, when I need a credit to balance the account, this is going to be a gain. Okay, so this will be a gain. The way I always want you to think about this is what happens when we sell equipment. And I always use this example, but it's a very important example to remember. When we have property, plant, and equipment, right? And then I have that accumulated depreciation, which is a contra asset account, right? This is going to have a balance over here, right? When I sell equipment, I always do this journal entry. I'm going to credit PP&E to make this go to zero. I'm going to need to debit accumulated depreciation on equipment to make it go to zero. I debit the cash that I receive. And so let's just throw in some numbers. If this was, say, 100 and this one was 20, and we'll say we sell equipment for 60. Okay. So to make this go to zero, I would need to credit this for 100. To make this go to zero, I would need to debit the accumulated depreciation for 20. So here I'm selling it for 60. If we think about it intuitively, the value of this equipment to me on my books is going to be 80, but my net book value is 80. If I'm selling it for 60, I'm selling it for less than what it's on my books for. So here I'm going to have a loss balancing of 20. Now, if I needed a gain, which is what we have in this situation up here, I would be basically showing here as a credit. So what I want you to think about, if I am doing this, once I remove it from the books, right, then what I need to kind of go through and figure out is do I need a debit or a credit to go through in the balance? It's a debit, I have a loss, credit, I have a gain. So basically this should be record retirement on bonds payable. Okay. So we've got that down. Let's now go ahead to our very last part, which is we did the journal entry to record the bond retirement. Now we need to go through and to basically record the interest expense basically for the bonds that we decided to go through and to keep. Okay. So on our books, this is what we have after this happens, right? So how do we go through now and, deal with the interest? Well, the interest is not really going to change except for there's no longer 15 million of bonds outstanding. So my cash paid for interest, my interest rate's going to stay the same at 6%, but that is always going to be an annual rate of interest. I'm paying interest semi-annually, so I'm going to multiply this amount by 6/12. I'm going to get 330,000. So when I'm paying interest for this here, whenever I have a discount that's basically been issued at a discount, I'm debiting interest expense on 12/31/22. Over here, I'm crediting cash for 330,000. And then I need to come over here and debit discount on bonds payable. So the shell of how I'm going through and recording an interest expense when I have a discount is always going to be like this because I need this to go to 0. Okay, so probably the easiest way to do this, because I basically, am taking 73% of what was remaining. I'm just going to go ahead and go to my 12/31. I'm going to go to this 15,252 and multiply this here by 73%, or 11,134. This is going to be the amount that I'm going to be going ahead and amortizing this by. So here, my amount of my interest expense is going to be 341,134. Now, how could we go through and check our work? Well, if on 12/31/22, this is 11,134, I'm still going to have to go through and make more payments for 23, 24, 25, 26, 27, 28, and 29. So I'm going to have to do this for 7 more years, doing it twice per year. So this is going to basically be 11,134 times 14. And I'm getting pretty close to that 167,000. So I know I did this correctly, right? Alternatively, what I could have done is I could have said, well, so if this was 22, so I've got 23, 24, 25, 26, 27, 28, 29, 7 months. And this is basically going to be so I've got basically 7 years. That times 2 is going to be the number of interest payments that I've got to make from January 1st, 2023 to December 31st, 2029. And then I add in the one from July 1st, 2022. That gives me 15 months. So what I could also do too is to say, well, if I take this divided by 15 more payments, again, I'm getting pretty close to what that number should be. So that takes care of my redo. Again, I want to thank my summer 2026 intermediate accounting section, which I appear to be making endless quantities of videos for, but that's great. And want to thank you guys for being here today. If you have any questions, or if I get more questions wrong, please feel free to reach out to me. And I'd be more than happy to correct myself. Have a great rest of your day, and I look forward to seeing you on the next video. Have a great one.